This week's trading commenced amidst a flurry of revisions. Firstly, the US labor market reports underwent adjustments following their release last Friday. And secondly, updated figures in Japan's gross domestic product were published. The latest data revealed that Japan's economy successfully avoided a technical recession last year. Over the weekend, some media outlets reported that the Bank of Japan might end its yield curve control policy at its upcoming meeting on March 18-19. The monetary policy known as a yield curve control, not currently employed by any other global regulator, involves the central bank buying government bonds in the open market to inject liquidity into the country's financial system. This action increases government bond prices, which in turn lowers their yields. It also leads to a depreciation of the national currency. In essence, the Bank of Japan has long controlled long-term rates and maintained the yen in a weaker position against major global currencies. Now it seems ready to abandon this strategy, potentially as soon as next week. As a result, the Japanese currency shifted towards bullish consolidation, while the US dollar, pressured by the yen, fell to its lowest position since the beginning of February. Consequently, against all six of its major counterparts, the dollar index reached its 7-week low on a Friday. The greenback started Monday around last week's closing levels below the 102.8-point line, and the US session graded it with bullish impulses, closely approaching the 103-point mark. Meanwhile, after several weeks of rallying, the S&P 500 index shifted to a decline on a Friday, a trend that continued into Monday. The index consolidated around the range of 5,111 and 5,120 points. On the daily time frame, technical resistance and support levels are situated at 5,225 and 4,816 points, respectively. The main reason for the US dollar's decline was February's non-farm payrolls. Like much of the US economic statistics lately, they turned out to be mixed. On the one hand, employment in February exceeded forecasts, rising to 275,000. However, after revision, the January report was cut by nearly a third, and unemployment in February jumped to a 2-year high. Despite strong figures, February's non-farm payrolls ultimately highlight the weakening US labor market, tilting towards an imminent rate cut. According to the FEDWATCH tool, the market's focus remains largely on the June 12th meeting, and this means 74% of the market anticipates a softening of the Federal Reserve's monetary stance. In contrast, forecasts for the similar decisions by the regulator on March 12th and May 1st stand at 2% and 25%, respectively. Meanwhile, predictions for a rate cut by the European Central Bank are set for earlier than in the United States, while only 17% of the market considers this possibility for April 11th. Expectations for the June 6th meeting are nearly 100%. ECB policymakers have stated in their comments that interest rate reductions could begin as early as this spring. Francois Villeroy de Caldeau deems it quite likely. Joachim Nagel, head of German's Bundesbank, notes that the possibility of a cut in interest rates before the summer break is increasing. After tumultuous end to last week, the euro started this week incredibly calm and quiet, consolidating along the 1.0940 line. This stagnation was partly due to a completely empty macroeconomic calendar, and market participants seemingly needed to catch their breath and reflect on the events since mid last week. Given that the euro-dollar pair nearly reached the 1.1000 level on the bullish impulse after Friday's employment data from the United States, its drop during Monday's European session below the 1.0922 line appeared quite abrupt. Considering the euro was in an overbought zone, such a pullback seems logical. However, from a technical indicator's perspective, the euro is currently in a recovery phase against the backdrop of a downturn in January and early February. In this context, the ongoing pullback could act as a reorganization of trading forces, implying that the 1.1000 level will eventually be breached. For now, the nearest resistance zone for the euro begins above the 1.0950 mark, with the support located at 1.0870. In contrast to the fluctuating rates of major currencies, the price of oil has remained around $82 per barrel for an entire month, showing minimal reaction to ongoing events. It seems that something truly significant needs to happen for oil quotes to move. Perhaps the upcoming decision by the US Federal Reserve could serve as such an event. However, it's not scheduled until next week. Today, Brent crude briefly fell below the familiar sideways range of $81.5 and $84, indicating clear seller excitement ahead of the upcoming US inflation data and OPEC reports, which will shed light on the outlook for demand. Should the price stabilize below $81, a drop towards the 80 support mark is possible. The Russian currency is comfortably positioned in the range of 90 to 91 rubles per dollar. However, it's important to remember that the ruble is more susceptible to political factors than any other currency. This Friday marks the start of the presidential election in Russia. Until then, no sudden movements are expected, but after the votes are counted, the market is likely to become more active. So, this week promises to be relatively calm. Although the dollar-ruble pair is currently trading on the strengthening of the Russian currency, technically it's in a stage of rebounding from the 90 support level. If the dollar gains the upper hand again, we might see the rate move towards 91.5 and 92. As for a downward scenario, the pair would need to consolidate below the 90 level during the day to trigger it. You have watched our global market review for Monday. Don't forget to leave your comments below and ask our experts any questions. The InstaForex team is here for you. Stay tuned for more updates.